Hi, this is Karen Lin. This is the part 2 of the video that continuing from the part 1. In the part 1, we talk about bank reconciliation when Lowell on July the 5th trying to reconcile with the bank. The Lowell's record shows $6,800 cash, but the bank only shows $6,000 cash because of the time difference that the two parties processed the check. So to reconcile these two records, Lowell decided to look for the things that are not recorded by the bank. It finds that the $800 of deposit that the bank missed on July the 5th. Of course, this is because Lowell deposited the check on July the 5th at the end of the day, the business day. So at the end of the day, if Low at the outstanding deposit to the bank's balance, it shows exactly the same amount as the Low's checkbook. So similarly, we will see that this is a summary of at the end of the day. If you look at the structure of this reconciliation is that we would start with the two lines or two rows showing the bank's um, balance and Lowell Corporation's balance. Okay, you can see they may not be the same. They can be the same, but they may not be the same at the end of the month or at the end of the day. So how we make these two records reconcile, or we find out things that are not reconciled, is by adding outstanding deposits to the bank's records, which just as what we discussed in a moment ago in the previous slides, because the bank missed a deposit that is not recorded. So we need to add that deposit to the bank. Notice that this deposit is recorded by the firm, but not by the bank. If the firm didn't record it as well, you don't have to add it because it's not contained in the firm's record as well. So I'll give you an analogy on bank reconciliation, which is when you reconcile the bank's record and the firm's record, it is as if you are syncing your iPad, iPod, iPhone with your Mac. Okay, so you are trying to find out what's in the bank's record and what's in the firm's record. Okay, if something is in the firm's record but not in the bank's record, you are adding or subtracting that to the bank. Okay, the other way around, if something is in the bank's record but not in the firm's record, you are trying to add or subtract that from the firm. So this is the structure. We start with these two rows and then we find out there are checks that recorded by the firm but not recorded by the bank. We are adding those checks. Those are outstanding deposits. Okay, if the bank wrote a check to a supplier, for example, but the bank didn't record it or didn't process the checks because the supplier didn't cash the check from the bank. Okay, if that's the case, because that check is already recorded by the firm, we need to make that happen to the bank's record as well. So we subtract any outstanding checks from the bank. Okay, that's the idea. On the other way around, on the other hand, if there is something recorded by the bank but not in the firm's record, for example, interest revenue, so the bank may accrue some revenue for the firm, but the firm didn't know it yet. When the firm gets to know it, the firm needs to add these revenue to its record to catch up with the bank's record. Similarly, if the bank charges the firm some service charge, that amount may already be reflected in the bank's record, but not in the firm's record. So we are subtracting those bank service charges from the firm's record. So after adding outstanding deposits, subtracting outstanding checks from the bank's record, we got one number. And then after we add interest revenue to the firm, and subtracting bank service charge, we we derive another amount for the firm. So these two amounts that after adjustment should be the same, which means after we sync our iPod, songs, for example, or photos on your Mac, and your firm should be the same. Okay, so that's the idea. Now, I didn't go over every transaction in the book. I just go over the ideas on a higher level. You should be able to read the book by yourself. All right, next, let's talk about accounts receivables. Accounts receivables are those monies that we are going to receive but has not received yet. One issue with accounts receivable is that there may be some accounts that you are not going to receive or not going to fully receive. For example, you are letting your customer to use a credit card or use credits, right? What if your customer goes bankrupt? And if that's the case, there may be some money you never get back. Okay, we call those bad debts. Now, in the first part of our lecture, we discussed a case that a firm decided whether to sell things on credit. Okay, so the Christian company always sold products for cash, so there's no risk here. You're selling for cash, and the company has sales of 500,000, um, uh, let's say for a year. But it is considering to increase the sales by if you could use credits. If you allow people to use credits, they may buy more from your company, right? So if we could allow credit, the firm's sales will be increased by 30,000. So that's the benefit of it. However, there may be a cost to it that's approximately 2% of the credit will never be paid back. Okay, that's the bad debt. The question is, how are we going to weigh between these two options? Notice that the firm has a very certain cost structure, which is 50% of the sales would be the cost of goods sold. Okay, and then it expects all the major expenses are 25% of sales revenue. Tax expenses will be 35 of income before taxes. Okay, so now we are going to talk about which options to choose. The first point you need to know is that when we discuss options and compare options, we always comparing the net income. We always comparing which option gives us more money at the end of the day, how much net income each option gives us. So we will start with sales, which is the number that's the sales revenue minus the cost of goods sold. In this case, 50% of the sales number is the cost of goods sold. That gives us sales minus cost of goods sold gives us the gross profit, which means how much profit we got from selling a product, mainly by only by selling the product. Okay, so that's the gross profit. Now, after gross profit, we will see that the company incurs some expenses like utilities, phone bills, insurance expenses, so on and so wage expenses, so on and so forth. Um, those are operating expenses 25% of sales. So operating expenses are on scale proportional to sales. The more you sell, the more operating expenses you are using, which is a reasonable assumption. And then there is a like collectible account expenses belonging to operating expenses. So we are singling out this because two options would have different expenses. Um, so using gross profit minus total operating expenses, which is the add up of the two, gives you income before taxes, which means that's how much money we earn before we pay taxes to the government. And the tax expense is 35% of income before tax. Okay, tax expense is always calculated using income before tax, not using all other things. Say you are not calculating tax using operating expense, gross profit. So income before tax multiplied by 30%, that would be the income tax. And then income before tax minus income tax, that gives us the net income. So the idea is that the money we earn is from the sales, but we need to minus the cost of the goods. And then we need to subtract all the operating expenses. We need to subtract all the income expense, tax expenses. That gives us the net income. So you can pause the video here and try to fill out all these numbers, right? And let's calculate how much net income you will get. Okay, So here is the solution. For option one, we sell 500,000 per year. Cost of goods sold 55% of sales, so that's 275,000. Gross profit 225,000 because it is 500 minus 275. That's 225,000. Um, operating expenses, other operating expenses 25% of sales. That's 25% of 500,000, right? That's 125. And there's no uncollectible account expense because there's no bad debt. You didn't extend any sales on credit, so it would be 0. So income before tax would be gross profit minus total operating expenses. That's 100,000. Tax expenses would be 35% of 100,000, so that's 35,000. Net income would be 65,000. So that's option one. Okay. Now, if we consider extending credit sales, the new credit sales will be 30. You can pause the video here and calculate the numbers. I'm going to review the numbers to you in my next slides. Okay, so the new credit sales 30,000, cost of goods sold 55% of this 30,000, that's 16,500. So on and so forth, you could calculate everything the same as before. Notice that there is an uncollectible account expense, which is the 2% of the credit sales. So it's 2% of the 30,000 credit that you give to your customers. So you are giving $30,000 of sales on credit. That incurs expenses, okay? So when we calculate income taxes and so on and so forth, it leaves us $3,510 of the net income. Now you can see this part of net income is only for the credit sales. So what is option two? Option two is basically option one plus credit sales, right? Because option two is extending credit to customers based on our original status. So option two is basically adding the two, option one and credit sales together. Of course, if you are very familiar with the material, you could do the 530,000 as option two, and then calculate cost of goods sold, calculate other expenses, calculate and then calculate the bad debt 2% only based on the 30,000. Okay, you can do that too. If you're less familiar with the material, you can use option one, calculate option one and the credit sales separately, and add them together to be option two. So if we compare option one and option two, obviously option two is better, extending credit sales is better, because even if we consider the uncollectible accounts expenses, it still generate a higher net income than option one. So option two is better if we could choose option two. Okay, so this is the idea of the bad debt expense. We would be able to extend credit sales if the benefit of credit sales outweighs the bad debt expense. So that's the idea. Okay. All right. So these are the two videos combined to be week five's main materials. You still need to read the book and lecture notes to understand the rest of the materials, but the rest of the materials are relatively simple and straightforward. I'm going to stop here, and if you have any questions, you're welcome to email me or bring up in the next chat. Thank you.